Hello everyone, welcome back to the artoftrading.net videos. This is Trader Stewie with you here again. I want to do a video this time just to talk about the market, just to talk about the SPY, the S&P 500, and see exactly what is going on right now in the market. As anybody who's been with the artoftrading.net service for for a few weeks now or a couple months would probably recognize this chart here. This is the daily chart of the SPY. It's a chart that I sent back in mid October. Well, the area I want to talk about right now is the chart that I sent back in mid October. But this chart, we've been watching it for a while now. The market from back in the summer went through a corrective phase in this back in March, April, and June, July timeframe. It went through a correction phase where it pulled back. The SPY pulled back, I think, about between 8 to 10% from the April highs to the June lows. It was about 8 to 10%, if I recall correctly. And as you can see here, it hit the 200-day moving average back then, and it bounced. You see that? And I remember, back at the time, there was a lot of fear in the market. A lot of people were concerned. We're heading back into a bear market, and everyone had their opinions. When the market starts to correct, everybody has their opinions. But in the end, you just have to follow the market and what it is trying to tell you. In the end, everybody has their opinions, but you can only trust one person's opinion, and that's the markets. So as you can see here, it pulled back. It was a very dramatic pullback. I remember it was kind of knifing lower, here, and then it hit the 200 moving average, and it stalled for a couple days, and then it started to move back up slowly. And as it kept going up, um, you know, it, obviously a lot of people were skeptical of the move, and as it gained more and more momentum, it ended up being a very, very amazing rally that took place from August all the way to October. Um, which caught many people by surprise. But what I want to talk about right now is what happened here in this little three little areas right here, these three circles right here. This is a chart that I emailed to artofTrading.net subscribers, and I remember when I sent this chart right here, I remember seeing these three areas right here, where the market, had almost like a euphoric looking spike here, where it went for a few days, it went kind of crazy on the upside, and then it got very, very overbought. As you can see here on the RSI, it got quite overbought here. So you knew that at that point, I knew that taking longs around this area here was going to be quite risky. That doesn't mean that the market cannot keep running. It definitely it could keep running, but at that point, the odds of a market pullback were getting pretty high. At least a small pullback, at least. So that's exactly what we got here. And then we got a second rally attempt here, and this is what I want you guys to pay attention to. When we rallied the second time here, okay, as you can see, we rallied and then we retested the highs of from right here. Okay, so this high here was pretty close to the high that we did back over here. However, look at this. There was a black candle here. The black candle meaning the market gapped up to retest the highs from back in early September. It gapped up and it closed down, but above the previous day's close. So that gives you a black candle. Okay, so basically, now what that means now is it means that the sellers are starting to sneak their way into the market. Okay, whenever you see like black candle, especially when you see black candles after a big run up, and especially near highs, near previous highs or resistance areas, that's when we have to be a little bit more cautious now, because now it shows you that, hey, the if we did not close strong, the market gaps up and then closes, well off the highs. That tells you that sellers are starting to sneak their way in. But more importantly, take a look here on what happened now. As the market retested the highs here, look at the RSI. Check this out. You see how the RSI made a big high over here, over 70, very overbought. pulled back and then made another rally, but this time the RSI made a lower high as the SPY index made a retested the top. So this technically puts it in double top territory. Now it doesn't confirm, that doesn't confirm a double top, until we start breaking down, but at least now you have something, you have an area to watch now. You know what I mean? So you have to be, you have like a guideline to watch, and this guideline is these highs over here. See that? See, if we pull back and we start shooting up again through and clear those highs, then okay, double top is negated. But as of right now, with the RSI making a lower low, we have a black candle here on the SPY, signaling sellers on strength. The market indeed did pull back for a few days quite aggressively, um, and then it held support. It held support here where I do this neckline over here, and I'll explain that here in a few minutes. But you can see we rallied again, but this time the rally was even weaker than the second rally. And you can see here by the RSI, it made yet another lower low, a lower high. So we had a high over here, okay, which corresponds with this rally attempt, and then pulls back, and we made another rally attempt which gave us a lower reading on the RSI. We pulled back and they gave us when we did another rally attempt, and which pulled back again here on the RSI. So now we have an SPY that tried 3 times to clear the highs from back over here, and all three both and twice. So we made a high here, it tried to clear it twice and failed twice, both times on the lower RSI reading, which at that point told me that the rally was getting weaker and weaker and weaker. So with every attempt it tried to push up, it got rejected lower. So that told me right there to be on the lookout for reversal candles, just like this one right over here. See that reversal candle where the candle opened up, rallied, and then came back off the lows, and it closed in the lower end of the closed on the lower end of the day. That created almost like a hammer looking candle right there. See, that right there is a warning sign when you see something like that, especially after a big run up like this. And we had another warning candle right here on a black candle where the market opened up and then closed lower. And then now we have another third warning signal, which is this red cross over here, this red doji, where the market opens flat, rallies, sells off, and then moves back up again to close flat. See, these are called dojis. So when you start to see those three pivot points here with a corresponding lower highs on the RSI, that chart right there gave me big red flags, and I felt like I had to email this chart to the subscribers and told them to be very careful from now on. And I remember this was this chart here when I emailed this red cross was on a Friday, and I emailed it over the weekend, and we walked in Monday with a big gap down right over here, and it had a very nasty close. So at that point, it was kind of confirmed in my head that this market was getting ready to correct in a very dramatic way. So over the last few weeks, that's exactly what we've been seeing. And as you can see here, I drew this sort of kind of weird looking head and shoulder pattern, where you can see here a shoulder type formation here. You have another little small shoulder here. You have a head here, and you have another shoulder here, a shoulder here, and you can kind of draw a neckline over here. For me, I never try to look for perfect head and shoulder pattern, because I believe the more perfect a head and shoulder pattern looks, the less reliable it will be, from my experience at least. So what I try to look for, if I do look for a head and shoulder type pattern, I like to look for irregular looking head and shoulders. So the ones that are hard to detect, by every technician out there. You kind of have to almost squint your eyes and kind of like really have to kind of almost use your imagination in some ways to really spot this one. And this one, it wasn't a very clear one, but you can see here how that 140, the high to mid 142 area was a very strong area of support, which also corresponded with the 50-day moving average. So as you can see, once it broke down below this area right here, this candle here broke down through it, even though we closed back up above here, it still wasn't a convincing enough reversal to for me to get aggressively bullish again, because at that point we had these lower highs here. We had the RSI that was not confirming the move, and we slow. And then not only that, under the surface we started seeing many stocks like Apple started taking a beating. And that was a big warning sign. When Apple, the market leaders, when they start to head south and start to act poorly, it's only a matter of time before the market starts to follow it. So as you can see here, guys, we made a big sell off here. We rallied back. It was a very goofy rally, very sloppy, lots of neutral candles, dojis and small hammers, and a weak volume rally here. And then we gapped up here to retest exactly the neckline from the head and shoulder. Look at that, this red candle over here. We retested the neckline over here, gapped up, and then closed lower. And we tried again. We tried to rally again, gapped up, made a couple days run, and then once again it stalled at the 50-day moving average, and as well the neckline from the head and shoulder pattern. And then boom, we broke down again hard here. This was the election. This candle here was the election from when Obama won. The next day the market took a gap down and just never looked back, sold off very hard. And now this is what I want to talk about right now. Right now, as you can see, we're testing the 200-day moving average again. See that? So we tested it here once, a few 6 months later. Now we're back here again, retesting it again. However, this time I want you guys to, why we need to be careful, we need to watch now, is how the market is going to act the next few days. I've been emailing subscribers and telling them, just we need to watch how, obviously, it wouldn't surprise me to see a bounce here off the 200-day moving average. And we did try to take a couple of longs here. Some worked, some did not. It just shows you how goofy and sloppy the rally has been, over the last couple of days, where we're testing the 200-day moving average, we're trying to rally off it. The rally is a little bit sloppy. It's not a very strong, convincing bounce. So, it wouldn't surprise me to see it last for a couple more days, maybe even go to like the 140, 142 area, maybe around here. We could see a bounce up to that 142, 140, 141 area around right here. And then, in my opinion, I think as long as the internals, as long as the setups stay weak, as long as the bulls lack conviction, and the news about the fiscal cliff and so on and so forth, whatever new Greece, Europe, whatever the markets is going is digesting, whatever news is digesting at that point, I would look for a reversal back down. I think in due time, if the bounces continue to be weak, they will set up, they will set up in bear flags, they'll set up in bearish formations, and probably break us lower. I think a break below the 200-day moving average, that would kind of bring in a lot of fear in the market, which I think is lacking right now. It doesn't seem like there's enough fear, even though we've pulled back, and it's been a pretty ugly pullback for many stocks. It just doesn't feel like there's enough fear in the market to create like a nice bottom like we did back over here, where sentiment was very negative. And there's a lot of people were very afraid. They were genuinely afraid that the market would go back into a bear market. I have no idea whether we'll go back into a bear market or not. We'll just have to assess the charts as we go along in the next few days or few weeks or few months. But as of right now, we need to monitor how the bounce quality looks like. If the bounce quality is as weak as the ones we've seen over here, then it will only be a matter of time before we start to break down below the 200-day moving average. And I think at that point, a lot of people kind of have to open their eyes and then start to really assess the situation. So, over the next few days, let's just see how this bounce acts. If it continues to act weak, then we need to be very careful. I think over the next, I do realize that we're going into a year end, and odds are very high, or very good that we see a Santa Claus rally. But we don't need to see a Santa Claus rally. The market, it doesn't owe you anything. It doesn't owe us a rally. Yes, history does show that November December timeframe tends to be bullish, but just be careful. Just because it's November December and doesn't mean that we have to rally. Let's just follow the charts. Let's see how this bounce looks like over the next few days. But if the bounce stays weak, I think it'll only be a matter of time before we break lower. And I think at that point, things will get a lot more interesting, I think. All right, I hope this video helps.